Hey guys, this is Dave with Moneyology.com. Hope everyone is having a great weekend. This will be our weekend market review for August 19th and 20th, 2017. We're going to look at various different ETFs that are performing very well so far this year and those that are performing poorly. And then we're going to take a pulse of the market, various different charts on different time frames, daily, weekly, monthly, that we believe are very important to the overall health of the market. Let's have a look here. So this is just a spreadsheet that we have that has some of the top performing and worst performing ETFs in the sector. Certainly the major traded ones. Nasdaq being at the top, led by technology, energy, telecom, worst performing so far this year. Some of the country ETFs led by Mexico, India, and Greece, and Russia, Israel, and Canada towards the bottom here. Commodities, palladium, lithium, aluminum, copper, all doing really well. And sugar, natural gas, oil, coffee, and grains. Just in general, agriculture looks very poor so far this year. And these are the list of 300 top ETFs, top traded ETFs in the marketplace. You can see here at the top, basically China, Turkey, Poland, China, a lot of emerging markets here. And at the bottom, you see a lot of agriculture and energy plays. So definitely a lot of momentum and contrarian potential opportunities to do your research on. Now let's look at some of the charts that make up the pulse of the market. So first we're going to start and look at the 10-year Treasury yield. And this is the daily chart. So it's been in a bit of a consolidation pattern here, and it looks to be weakening, which tells us that the yield probably will be falling in the not too distant future. There's a number of gaps here between 19 and 21 that may be filled, and so we'll see what happens on the daily. But taking a step back on the weekly chart, the yield is in a bullish longer-term pattern. It broke out of this downtrend since 2014 over here in late, frankly, after the U.S. election in November, and it's been consolidating in this bullish flag formation. And we believe ultimately it's going to break to the upside, but there might be some more downside, possibly as low as 21 or possibly even as low as 18. So stay tuned. We certainly see the MACDs are rolling back over. So we believe that there's, in the short run, going to be lower prices ahead in the yield. And here's a monthly view of what I'm looking at. Again, a bullish flag formation, but I think we might still test this bottom zone of this flag formation, which, once or if RSI breaks this 50 on a monthly basis, we think that this is going to take a dump towards that 38 zone of support here that we found support multiple times. Which would probably be around that 18 to 20 area. So stay tuned on the 10-year Treasury yield. Let's take a look at the gold chart. So gold's been doing very well. Frankly, it closed the day at just under 300. The daily chart looks like it's getting ready to break that 1300 barrier, and with a target of 1320 for its first real major resistance at that point. It broke out of this downtrend that it's been in for a little while. RSI did in, I'd say, late July, so we've retested it a couple of times here, and now it looks poised to break above 70, and that's when the biggest moves happen. So could see a big move in gold in the coming days and weeks ahead. On a weekly chart, gold, goes to show you what we're seeing, what we were looking at in the daily, broke out of this downtrend here, trend line in the last couple of weeks, and now we're testing this 300 zone. We're about to break above the 60 area on the RSI, which served as resistance in prior points over here, and we think that this now is getting ready to break to the upside. And here's a monthly chart all the way back since 95. So been in the downtrend since middle of 2011, and we believe we're very close to breaking it. Now, of course, we've tried it before, so no guarantees in the market, but various different signs suggest that this time is definitely different. And well, stay tuned. Let's see what happens. One thing, what do we see here that's positive? So the MACDs are starting to curl back higher, which is a very positive development. Notice here when we hit it, MACDs have started to slightly roll over here. Here we were also rolling back over after retest, after bouncing off the Bollinger Band, but we were rolling over on the MACDs. So these moves were not led by strength. This one is. So definitely, if this breaks to the upside on a monthly, this could be a big move where we're going to likely retest these highs from 2011 and start a multi-year uptrend. High yield bond fund. So high yield bond fund is important. It tells us really the pulse of the overall credit markets. So on a daily time frame, it looks like it's got a little bounce potential over the next couple of days. We hit a low here a couple of days ago, and we bounced, and now we're bouncing again. Let's see what happens when this 50 RSI is tested, which probably coincides with this lower Bollinger Band. But when you take a step back on the weekly time frame, what you see here is this bearish wedge that had developed for about 2 years, and it broke down pretty decisively in late July, early August. Excuse me. And while we may retest this from the downside, we believe that we're going lower and likely to test this 3450 area before determining the next direction. But that'll also coincide with this 50 RSI, which should serve as very strong support, but not necessarily long-lasting support. So we'll see. Another evidence that we're going lower is these MACDs are starting to make new lows over the last year. These are the lowest point that it's been. Money flow is going in a negative direction, and on a monthly time frame, this is a very ugly doji candle here. And again, we think that this area of 35 is going to be tested, and let's see how it does. When RSI breaks below the 70 overbought area, some of the strongest moves to the downside do occur, and this is what we're starting to see take place here. So remains to be seen how long this move, how far this move goes down. But we think that the middle Bollinger Band, which will coincide with this area of support here, 3450, is a strong possibility. So junk bonds, stay away for the time being. Crude oil. So we've been very bearish on crude oil for the last year and a half, and since it's been trading around 55, we called the expected low into the 40s, possibly the 30s. And so here we tested it 42 multiple times in the low 40s. We had some divergence here, which where we saw a lower price, but RSI did not confirm lower momentum, and we expected that to serve as short-term bottom, and it sure did. Rallied from 42 all the way to 50 in the matter of a couple of weeks. Now remains to be seen. We're battling the 50 area, but here's why we're bullish. So looking at the weekly time frame, oil broke out above this downtrend that it developed in since start of 2017 on RSI, and it was a decisive break to the upside. And while now we're dumping right below this 50 line, it's very possible that we retest 45, but we believe that this downtrend has ended, and whether it retests and then goes higher or starts turning right around here remains to be seen. But we believe that oil is ultimately going to test this 200 EMA this year around 58.32. So a lot of good opportunities in oil should our thesis play out. And taking a step back on the monthly, there's a potential inverse head and shoulders pattern developing here with first head 2015 first shoulder. Here's the head, and here's another shoulder. If this neckline breaks above this 50, say 58 area, potentially we might yet see 60 to 70 handle, possibly as high as an 80 handle in the next coming years. But again, this is just artwork until it gets confirmed. Watch for a break above 50 on the monthly RSI to confirm any long-term directional move. But we think it's setting up for a very beautiful move to the upside in the coming months and years ahead. Nasdaq daily, it's been pretty bruised here in the last couple of weeks, from a high of about 64.60 all the way to 62.13 right now. Here, we had a nice little bounce back candle today, and we might find this support level holds for a couple of days here around that 38 to 40 level on the RSI. We found support here, here, and here in the past. So I wouldn't be surprised if we see a bounce towards this middle Bollinger Band, but the correction has definitely started, and you'll see this as we look through some of the other equity charts. Looking at the weekly here, it just greater perspective. Multiple attempts at breaking and staying above the 70 area have failed, and now we've broken below 60. And again, while we might still retest 60 from the downside, ultimately we think that there's high probability that the Nasdaq heads down towards the 58.50 level here, around the 50 EMA, as a first test of support, and that will coincide likely with the 50 RSI level, which is generally strong support, and we've seen various different price points in the last couple of years where it served as support here. So stay tuned on NASDAQ, and here's a monthly chart. One of the things that RSI is beautiful for is it tells us where past points of breakout and rollover serve as resistance and support. And we saw new highs in this massively bearish wedge pattern that's developed over the last year and a half, but RSI did not make new highs. We have higher highs in price, lower highs in RSI. That's negative divergence. You don't want to see that. And if this breaks below the 70 level, which it looks like it's getting poised to do, the price action has already broken down below the set wedge. We think that there's pretty dramatic downside potential here, certainly to the 54.20 area, which was really the breakout zone for this most recent parabolic move, but could be even lower prices all the way down to 4,000. So we'll see. Nothing is for certain in this market, but a correction has begun. So I would, if you're fully invested long, consider trimming. If you have cash, I would not be deploying it quite yet. Russell, one of the weakest major sectors in the market. It's hovering right below this 30 level on the RSI. If it breaks below that, expect another dump in the market. But I think that we're ripe for a nice little bounce back rally, perhaps to the 1380 level, perhaps to that middle Bollinger Band around 1400 on the Russell. But if you look at the weekly, we are just in the early innings of a correction. Now, again, the weakest of all the three major indices. Look at this. Whereas the Nasdaq is still above 70 in RSI on the weekly, this is well below 50. And once it drops below 50, look at the move that we see does take place. So could retest 50 from the downside. If it's unsuccessful, I think this is going to dump, and it can dump hard, possibly to as low as 1150. So massive downside. What we do know is that this uptrend from 2016 has been decisively broken, and that's something to be aware of as you consider how you want to be exposed in the market. And here is a monthly chart, and again a shooting star pattern here, and we're breaking below the 60 level on the monthly, and looks like we're going to test that 50 on the monthly RSI. We think that a reasonable correction brings us down to around that 1100 to 1150 area, which coincides right now with the monthly 50 EMA. But if this turns into a recession, we can go as low as 900, and this is why monthly charts are so important. They provide us pretty nice perspective. S&P 500 daily. So S&P is weak, just like the Russell. It's broken below the 50 on the daily RSI. We might see a bounce here in the next couple of days. Wouldn't be surprised. But as we look at the weekly time frame, we've broken below the 60 on the RSI here. And again, look at this. If it tests the 60 level, which we believe it probably does this week, and fails this test, it's headed back. It's headed to test the 50 on the weekly RSI, which served as support here, 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 etc., etc. And that'll likely coincide with that 2300 level, possibly as low as 2200 on this correction from a weekly time frame. Now, taking a look at the monthly on the S&P, again, we're looking like we're getting set to break below 70, and that's when some of the biggest moves do happen. A monthly support doesn't really come until around the 2050 level. So if this correction goes a little bit longer than what most pundits do and expect right now, expect 2050 to be fairly strong support. If this turns into a recession, possibly as low as 1800. Don't think that's going to happen, but anything's possible. Very quickly, the tips to 20-year Treasury bond ratio. This basically is a sign of how inflation's doing, and you want to see this breaking out to the upside if you believe that the market has long-term inflationary potential. This is a bullish flag, so this coincides with rates going higher as they started doing, as we saw in the 10-year Treasury yield chart earlier in this video. We started rallying since 2016, and now we found this resistance here, and now we've been flagging. And while I think we still have a little bit lower to go, I think based on these charts, it looks like the interest rates are going to correct a little bit more as the market goes down, but this will eventually break to the upside. And when it does, this is going to be a great opportunity to be buying agricultural names and just many commodities, which will likely break to the upside and will likely coincide with lower dollar prices. So stay tuned there. And monthly, again, another perspective on this bullish flag. So big move higher. Now we've been correcting here. Could go as low as 80.85 on this ratio chart, which would likely set up a inverse head and shoulders here with one head, one shoulder, and then another shoulder here, and also basically a cup and handle pattern. So we believe in the long run, interest rates not only are going higher, but are creating a setup that's going to create pretty remarkable moves to the upside. And so anyone who owns fixed income, you're going to have some couple weeks and months ahead that are going to be nice. But when this move does break above this neckline at about $1 on this ratio, or 1 on this ratio chart, there's going to be a lot of pain in the fixed income sector if you're long. So stay tuned and definitely keep an eye on this particular time frame. The U.S. dollar. We've been calling the dollar short since we've been consolidating unsuccessfully, breaking higher around this 101 to 103 range. And why do we start getting bearish? Well, for one, the prices were going up and down, but the momentum was waning, and that was a divergence that foreshadowed lower prices. And now, what we've seen here is some positive divergence, and this downtrend that we've seen here has been broken to the upside. We've retested, now we're retesting again, and it remains to be seen what happens here around that 38 level. If it can hold, possible double bottom test at 92. You see this when you fail at 50, very often traders just get out, and so we'll see what happens on the daily. Now on a weekly time frame, the US dollar still in a downtrend, and it's basing around the 92 level below the 50 or the 200 EMA on the weekly chart. So we'll see here. If it breaks below this 91.50 area, expect much lower prices on the dollar. But RSI is starting to break a little higher, so again, starting to show some momentum. I wouldn't be surprised to see this break to the upside and make a move towards the 50 EMA at about 97 and eventually roll back over and present some great shorting opportunities. Dollar chart on the monthly. Well, this chart is since 95, so it shows a very nice perspective. We're still in a bullish move in the dollar from a longer time frame. But as I pointed out when we were around here, I think that dollar ultimately bottoms around that 85 to 87 range. And so that's going to be very bullish for commodities and specifically precious metals. And a lot of folks are going to say, oh, the dollar is in a bearish, in a new bear market. But no, actually, the dollar is in a very bullish consolidation. We had from 2008 to 2015, the dollar was consolidating between 72 and 85 and finally broke out here. And this is just a standard consolidation above that 85 to 87 breakout range. And we think ultimately it's going to find support either at this RSI 38 to 40 level or possibly as low as 30, which coincides with this breakout point over here when it broke out in 2008. Bottom line is the dollar, its MACDs are at its lowest point here in the last 3 to 4 years, and the dollar is very weak and much lower prices in the dollar ahead, despite a possible bounce in the short term. Finally, I believe this is the last on the list, is the VIX. The daily chart is too messy, so we're going to go a little further back for some perspective. We've got this bullish flag here that I pointed out before, and it looks like it's getting ready to break it to the upside. We broke above 50 on the weekly RSI, rather 60, and we dipped below that. Now we're headed towards potentially testing that 50 level from the upside. We believe that'll hold, and when it does, that's when the next big move to the downside in the market and upside on the VIX will be. Take a look at this monthly VIX, really important. It's right below this 50 level on the weekly RSI, on the monthly RSI. If this breaks to the upside, and we believe it will happen here because the MACDs are rolling to the upside, stochastics are starting to strengthen, this is going to be the first of major volatility in the coming months ahead, and this could go as high as 45. And if it does, that'll definitely, well, I can't say anything for sure, but it could be the first signs that a recession is coming. But again, we'll let the market make that decision, and we'll follow along and trade accordingly. And let's see what else we got here. Finally, here is the World Index ex-US, and the daily looks like it's finding some support around this 1900 level. Might even try to rally here towards this middle Bollinger Band. But when you look at the weekly time frame, this uptrend that we've had in 2007 has broken to the downside, and we think that there's pretty nice downside in the coming weeks ahead. Probably a dip to the 1800 to be sure, and we'll see what happens thereafter. MACDs are firmly below zero, and on the monthly time frame, hey, look, it's been a very beautiful move to the upside, and it's finding resistance, not surprisingly, right where we found resistance here. But the reason why we like world stocks versus, say, the NASDAQ or others is there's positive divergence. Look, we've double topped here, and yes, we probably pulled back to the middle Bollinger Band around the 1700 level, 1726, but RSI is much higher here than it was here, which suggests that there's some significant momentum in this space. And so if you're long the markets, you want to be long emerging markets, long international markets. This might dip to retest this 50 zone on the monthly, but when the rally does occur, or when the recovery does begin from this, what we believe will be an impending correction, there's going to be some significant upside. So stay tuned, and that's it for our review today. So anyway, we appreciate your follow, and follow us on StockTwits at Moneyology, Twitter at Moneyology, and please do subscribe to our YouTube channel at Moneyology. And please leave your feedback, any other sectors you want us to take a look at. Any constructive feedback would be much appreciated. Again, thank you for your support, and have a wonderful week.